Pitch Ghana is brought to you by Hope Channel Ghana in partnership with Seed Spring Network and proudly sponsored by the Adventist Heritage Cooperative Fund Limited and the National Entrepreneurship Innovation Program. Previously on The Pitch.
Today is Judgment Day because they will be facing the board to present whatever they have in their hands to them. Like it happened that the last time, each one will go through their business. They would have a few minutes to do that, and then the judges would actually query them into what they have done. But today, there's going to be eviction. Judges, you're welcome once again, and I want to present to you your first contestant, Chris. Over to you.
Good afternoon, esteemed judges. I'm so thrilled to present the business model canvas for iWorld AI mobile app. So basically, we're going to leverage virtually every social media platform and also all the 300 plus mobile app stores to, that's the channel, to get our app to the consumers. And the customer segment is very simple. We have the B2C, that forms about 80%, the business to customer or the individual, that forms about 80% of the customer segment. And for the rest, the 20% has to do with business to government, business to business. And basically for tech-savvy individuals and more any mobile app user, that's for the customer segment.
Good afternoon, judges. I am Ms. Jennifer Tando, the CEO of Ask and Ice Hub, and today I'm going to present to you the business module canvas of Ask and Ice Hub. We are partnering with fruit suppliers in our locality, so we source our fruit from local farmers in order to solve the SDG goal 1, which is no poverty. What value are we giving to the market? We are providing nutritious, rich fruit juices to the people to refresh their nerves.
So we want to thank you all contestants for taking the time to go through some 2 weeks of very, very hard work. And like we said, 2 of you will have to go. But the important thing is that whether you leave us or you continue with us, remember that what you've learned here, what the faculty has taught you, what we have taken you through, the comments and everything, will be relevant for the future as you go along. So keep that in mind. So for today, the 2 persons who are going to leave us will be Samuel Apia and Chris Oseipoku. Samuel Apia and Chris Oseipoku.
Welcome back.
Good day, friends, and welcome to another insightful episode of The Pitch. At The Pitch, we say dreams become reality. I know you have been enjoying the show as much as you are being educated. Last time, it was a sight to behold when 7 of our contestants made it to the next stage of the competition. Sadly, Chris and Samuel are out of the competition, but the journey goes on. My name is Chaplain Elom Edison, and I'm going to be your host who is still going to journey with you throughout this competition. Remember that this program is an initiative of Hope Channel Ghana in partnership with Seed Spring Network, and we are happy to have the Adventist Heritage Cooperative Fund as our sponsor, together with the National Entrepreneurial and Innovative Program and our donors. We'll be right back after this break.
We'll be right back. The Pitch Ghana is brought to you by Hope Channel Ghana in partnership with Seed Spring Network and proudly sponsored by the Adventist Heritage Cooperative Fund Limited and the National Entrepreneurship Innovation Program.
Hi, I'm Elizabeth Kusimsia, CEO of Adventist Heritage Cooperative Fund Limited. We became a self-help cooperative fund on September 20th, 2022, with the sole aim of helping church members and institutions to become financially independent. The Adventist Heritage Cooperative Fund Limited has the following financial products for individuals and institutional members. Institutional products include a savings account and the purpose-driven account. We have the individual member products, which includes the Menidaso, the Medachi. The kiddie account can be opened for persons under 18 years by the parents or guardians. The CEO of the fund, I can confidently say we have been very successful and profitable since we were set up. My assurance to you, therefore, is this: your funds are safe with us because we have a team of qualified professionals with experience in fund management. Together, we can make you financially independent. ACOF, we make you financially independent.
Our donors on the pitch include Innovate Black, the Chill River Resort, J Modern Health Services, Gracious Grace, E-Juice Company Limited, K-Park Mineral Water, Ephesus Business School, Kweku Outlook, and Sealand Shipping and Inland Services. Welcome back.
Welcome back from that break. Today, Edmond is going to take them through a very interesting discussion. Remember the task that was given to them by the board, right? I have a premise for you. So Jesus said this thing in the Gospel of Luke chapter 14 from verse 28, where he says, "For which of you, intending to build a tower, does not sit down first and count the cost, whether he has enough to finish it, lest, after he had laid the foundation, is not able to finish, all who see it began to mock him." Now, Jesus said this to help us to understand that as entrepreneurs, whatever we do, we need to count the cost. Talking about accountability, the board gave them the task to do what we call financial projections, and they need to be able to justify whatever they put before them. And so today, Edmond is going to take them through the financial projections. Take and stay with us as Edmond do his job.
Hello, good afternoon to you all. How are you doing? Very good. So, what has been your experience with the previous discussions?
In fact, it's been very educative, especially with the business module canvas. I had an idea, but when we're taught, I realized that there was a lot more into it, and it has really helped me, especially with the fact that we need to link each of the boxes, and it has really helped.
Oh, very good. I think all of you are improving day by day.
Oh, yes.
With all the discussions. That's the aim. That's the aim. That's very, very important in addition to your final goal. Very good. Today we are going to have another wonderful topic. That is a major part of any pitch deck, and that is financial projections. Financial projections. So that is what we are going to do today. And honestly speaking, when it comes to pitch decks, is one of the most confusing area for some people, not everyone, for some people. And today I'll do my best so that with you it will not be a problem. You'll be able to sail through. Okay, so, and the reason why it is so for some people is a bit confusing, is that it combines three things. We are going to combine three things, and a lot of people do not appreciate how these are combined. Now, the first out of the three is the methodology. The method that you have to use. And the method involves a little bit of accounting principles, basic accounting principle, then finance, then mathematics. Because we are going to deal with facts and figures in a certain standard formats. Because all that you've done, here is the time that you translate them into facts and figures, numbers. And that is what we are going to do. So those of you who have had a little bit of accounting background is an advantage. But then, it does not necessarily mean that if you haven't done an accounting before, you can't do. No. You may even do better than those who have done accounting. That is it. That's the good news. Then the second aspect of it is that we are going to use something called assumptions or KPIs, key performance indicators. And that's the second aspect of it. Of the reason why it's a bit confusing to some people. Assumptions or key performance indicators, which I will be using the acronym KPIs. What are they? They are just estimates. They are just calculations. They are just targets. But we are going to create our own just to conform to whatever business we are doing. But I'll talk more about that because the whole thing that we are going to do will be based on these assumptions and key performance indicators. So I'll talk again about it later. I'll explain a bit details later so that we can create our own ones. Then the last part of the three that makes it a bit confusing is the results. The results are what, by using our key performance indicators, will be the output, the outcome. So we shall be using our KPIs to create results. So whenever you take anybody's financials, you see the paper being populated with numbers. So all the numbers there that you see are what we are calling results. So you see the results, all kinds of numbers, figures over there. But the KPIs and assumptions are undercurrent. They are underneath. You don't usually see that one. You only see the results. But the results is a combination of the accounting principles, the finance, the mathematics, the KPIs, all combined to create that results. So all that we are going to do today is to help you, guide you, so that you can create your own KPIs, assumptions. Then you can use that one with whatever information that is available to you for your business to create that resource. It's the result that you'll be presenting, but you'll be defending that result with your KPIs and assumptions. Now, let's see the importance of it. Why is it? Why are we spending time on this? Now you'll be meeting the board, and you are going to meet the board to present your financials, your financial session. And assuming the board that you'll be meeting are investors with money who are ready to give to finance businesses. Assuming you've been able to convince them that you've been able to identify a major problem. You've convinced them that you have a unique solution to relieve people from that problem. You have a unique solution to provide a need. You've convinced them that you have a great market opportunity and a great team to work. Now is the time that you are going to translate all that you have into numbers and figures to convince them. But it's not just a guesswork. The numbers and the figures must be based on fact-based data. Fact-based. data. There must be factual. And these numbers must convince the board or the investors that when they put in their money into your business, there is a bright future for them. That's the idea. And that's the importance. How can you convince them with fact-based data, numbers, figures, that you can really defend, scientifically proven? That is the essence of it. And be mindful that it's not only the board, but a lot of people, a lot of entrepreneurs, investors, lenders who will be watching you too from the whole country and outside the country. Who knows? Probably with your ability to present such a fact-based data, some people may enter in to provide finance that will turn your fortune. So that's the importance. And also take note that in the mind of every investor, there are certain questions. At least 4 major questions. Number 1, how much would that business be making? How much money would that business be making? At what cost? Number 2, at what cost? Number 3, how much money can I, as an investor, be making out of it? Then number 4, when will the profit start flowing? Because we all know that a lot of businesses start and they start with losses because they have to inject huge capital. Then it takes some time before profit start flowing. So these 4 major questions are in the mind of a lot of investors. There are a lot of other questions that are there, numerous ones. But these are the key that are in the mind of investors and people who want to provide funding. And your financial session must be able to meet this expectation. Now with the financial session usually deals with 3 major documents, financial documents. Income statement, which is also called profit and loss statement. Then the balance sheet. Then the cash flow statement. But we are going to concentrate on income statement. That's what we are going to concentrate. Balance sheet and the cash flows, I think I have to give it to you as your assignment. Balance sheet, in a nutshell, give an overview of all the assets that the business owns. Then all your liabilities, whatever you owe. And whenever you subtract the liabilities from all that you own, you have to get the owner's equity, whatever belongs to you. So the balance sheet provides these figures, and usually at the end of the year. So that is the overview of it. What about the cash flow statement? But the balance sheet gives the investor an idea about how you allocate resources and how you leverage on debt, and also how you increase the value of your shares or the company. For the cash flows statement, it provides the inflows, all the inflows, or whatever the business will be getting. Then also the outflows. How are the resources moving out? So that is that. And how even you handle the contingencies in the businesses. And that is that. But I said we are going to concentrate much on the income statement. So now we are starting with the income statement. That's the core of what we are doing today, the income statement. And I'll be giving you the steps how to create the income statement. I'm providing about 5 steps to create a very good, very convincing, very attractive income statement that will be appealing to investors, lenders, other entrepreneurs to be able to invest in your business. That will be appealing to the board that you'll be meeting. To about 5 steps. And the first steps, number one is to gather relevant data and information pertaining to your business, pertaining to your enterprise. You had a very good time with the speaker who took you through market research and analysis. Is it not so?
Yes, sir.
And that is the purpose. That's one of the major purposes. There are data and information out there, numerous, a lot. But a lot of them are not relevant to you. But some are relevant to you, to your situation. That is what you are going to gather. And you know that the sources through the previous discussion. Those of you who are already in business, you can get them, some of them from your historical results. If you have that, then you can get some data, very, very important, from that historical data. Sometimes to the customer feedbacks, you get some information and you translate it into data. Then also the external ones, industry reports, trade association reports, online sources, Ghana Statistical Service reports, and so on and so on. There are a lot of the sources that you can get these data from. Okay. After getting these data, what do you do with them? You analyze them and you structure this information and data into information and data that you will need. Some of them are already prepared, so you just pick it, and it's that for use. Some of them you have to do the calculations and get what you need. So after doing that, then the next step, the second step, is to use those data to create the KPIs that are also called assumptions. Now, you are starting a business. It's a new business. Now you need certain information. This product that I intend producing, how much will it cost? So you want to know how much it will cost to produce it. That is why you need to check those who are producing similar products, or the same products or similar products. You check from those information, you gather the information, and now you say, okay, now I've gotten it. Now with all this information that I've gathered, now I know I can produce per unit cost. I can produce each product at the cost of 10 cedis. And that 10 cedis that you've arrived at as the cost per unit is what we are calling key performance indicator, KPI. It's what we are calling assumption. Now you are going to apply this, that okay, now, because if I intend producing one, it may cost 10 cedis. Now, if I'm producing 1,000, how much will it cost to produce? Then what do you do? What do you do? If you want to produce 1,000, what do you do? Yes? You know the cost. So if you intend producing 1,000, what will you do?
You either multiply it by 1,000 or you go to the
and
market
that is it.
to look for it.
And that is it. So from the beginning, I told you 3 things combining, and that's why it's creating some confusion for some people. Now you have created a KPI, which is the 10 cedis from your research. Now you intend producing 1,000 this year, and now it has come to mass. The KPI 10 cedis multiplied by what you intend producing, which is a projection 1,000. You multiply and you say, okay, now it will cost me 10 times 1,000. That will be 100,000. So you are projecting something into future by using a KPI. But the KPI becomes an assumption because you may not know what happens this year. At the end of the year, that 100,000 that you projected as your cost, it may happen that you could be more than that or less. And that is why we said the 10 cedis that is the KPI is an assumption, because you don't know what will happen in reality. Okay, then you also decide how much will it cost? How much will I sell it? Now you know the cost. You have decided on a KPI for the cost, and we call it cost assumptions. Now you want to know the revenue assumption. So how much will I sell it? Then by checking from the other competitors, doing your market research, other competitors or those of you who are in operation, by checking from your past records, the historical records you've known, you've gotten a rough idea. Now by producing it at the cost of 10 cedis, I can sell it at 25 cedis or 20 cedis. So you are using the 20 cedis to also project. So to get a revenue for the 1,000 that you intend producing, you do the same thing, the multiplication. So now you are using the KPIs, the assumptions, and the mathematics. So that is that. So you use it, you use your information and data to create the KPIs and assumptions. But then, for it not to confuse you, you limit it to about 3. Either you use one KPI, one assumption, or you use 2 up to a maximum of 3 to create your income statement. There may be other assumptions, but you don't show it on your financials. They will be underneath. They will be within you. But when you are creating this thing for external purposes, you indicate, you show a maximum of 3, that these are the key ones that I'm using to create my projections.
We will be right back. The Pitch Ghana is brought to you by Hope Channel Ghana in partnership with Seed Spring Network and proudly sponsored by the Adventist Heritage Cooperative Fund Limited and the National Entrepreneurship Innovation Program.
Your friend Philip Entry, na me ma na save our Akov. I am pembe na manfo nim baby a musika omu save no. Ano ma hodo bank na say financial institution omo de call ho no omo de ye adwuma. But media me gidi say me de call baby a skare de be ye adwuma e be so nyakopo ani a enhira pipi be ba me so. Me sika ba me nsam a baby be pe a me dwene ho say me de be call ye Akov. Say be ya daachi bi no me hia so a me menya no entem so let me aboa me na de be say me de ye o mabrabo mu no let me akọ nanim. Mudwumadie ba ko a eso bani pa ye kwan a so di sika kọto a na wo pese wo nya sika no a kwan a wo fa so nya ne tentem so no eno kra na ye kumi no Akov ye hwe amos sika sem na waduma dudie ni na no akọ nanim.
Akov will make you financially independent.
Welcome back.
All the per unit numbers are part of KPIs. If you see anything, price per unit, cost per unit, this per unit, any unit economic is a KPI. Do you understand it?
Yes, sir.
Okay. Now, the percentages. Anytime you see growth rate of customers, growth rate of revenues, growth rate of price growth, whatever growth, the rates are also KPIs. So number of customers are KPIs. The cost per unit is KPIs. Cost per unit or cost for acquiring customers are KPIs. So these are all examples of KPIs. There are several KPIs that you can create. So it's up to you to look at your own situation and ask yourself, what type of KPI will I need? What type of assumption will I need? And we are saying that we have revenue KPIs or revenue assumptions. Then we have cost KPIs or cost assumptions. What's the difference? The revenue assumptions or KPIs will help you to create or to project the revenues into future. Then the cost KPIs or assumptions will help you to also create the cost and project it into future. Because after all, income and the income statement, we are going to deal with revenues and costs. Then the outcome will be the profit or loss. So we are dealing with two major variables, revenue and cost. Both will net to give us the profit or loss. And that is what we are doing. So we have these two groups of assumptions. And these KPIs, we are spending a bit of time because that's the base of everything. These KPIs tell the investors where the growth in your business, the expansion, the benefits in your business will be coming from. So every investor will be looking for the KPIs to see whether in reality your business can grow. The KPIs. If from your research work you can prove that the revenue growth can be 30%, 40%, and you are able to back it with fast, real information, then the investor will be comfortable. That okay, 40%, 35% growth of revenue, very good. So it's the KPIs that will be telling the investors, that will be helping the investors to have confidence in your business. And is the KPIs, is at the KPIs level that you lose or you win. Assuming that the cost that we used, cost per unit was 10 cedis. Now, that's the average cost per unit in the industry. And you pick it from the industry report. From the competitors level, that's what is happening. But you've been able to get a very good source of raw materials. And after producing, you see that the cost that you produce was 7 cedis. What is happening? What will happen to your profit? It will what? It will increase. Why is it increasing? It is because you projected on the assumption of 10 cedis cost per unit. But at the end of the day, after implementation, after producing your products, your cost is at the level of 7 cedis. So you are winning at the level of the KPI that you set. But after producing, if you realize the cost is 13 cedis, what is happening? You are doing what? You are losing at the level of the KPI because you are now you are not competitive. Other people can outcompete you easily because they may be producing at the level of 10 cedis. So we are saying that you can win or lose at the level of KPI. That is why the KPIs are very, very important. So we use the information to create the KPIs, and we are using the KPIs to create our income statement. In the income statement, we have components: revenue, cost, then profits. So now we are going to the revenue session. With the revenue session, the metrics that the board and the investors will be looking at are what are your historical costs in case you are in operation. If you are not in operation, what will be your projection for the revenue 3 to 5 years? If you are in operation, to the same thing. So your projection and your historical that the investors and so on will be looking at. Now, what happens is some people usually overestimate in order to convince. But when you overestimate, at the defense time, you will not be able to defend it because the facts, the KPIs will not prove it. And if you underestimate too, what happens? It tells the investors that that company is not all that feasible. It may not be profitable to finance. And that is why you need very good KPIs so that you neither overestimate or underestimate. You become more realistic with your figures and your guesses. Now we move to cost, then we do a group assignment. Cost 2, we have direct cost and we have the indirect. The direct costs are all the costs that will accrue from materials that help you directly to produce the products. If you are producing tangible products, the cost of raw materials is a direct cost. The cost of rent for the production floor is a direct cost. The electricity and the utilities for producing that product is a direct cost. The salaries for the workers who are directly producing the product are direct costs. So all these combined, we call it cost of goods sold. Cost of goods sold. That's the direct cost. The direct cost varies directly with the sales or the revenue. Then the indirect costs are the overhead and administrative costs. The salaries for the salespeople, the sweepers, and so on and so forth. So all the salaries, the bonuses, the rent space, and all those things that are not directly related to the actual production are the overhead costs. They are the indirect costs. Those ones don't vary with revenue and production. They can be fixed for some time, then it changes a bit. That's how both work. Now, at this level, I want us to do this assignment. We are going to do this assignment. Assuming we have a company that has that computes something from a historical data. They computed some things, annual growth rate of customers from 2022 to 2024. And that was 30%. Then also 2022 to 2024, the customer figures are given there. 1,300, 1,690, and so on. Then they calculated also another from the same source. The spending per customer, 12 per year. Now let's group ourselves into two. Let me see. 3 of you here in the same group, then 3 of you here, then 1 join. Quickly, so that we do this group work. You are going to give me certain answers. Okay. Now, the first question is, how many KPIs, or what are the KPIs that you see?
Okay.
From the case study.
Okay, so I'm seeing 2 KPIs. One is the customer growth, and then we have the customer spending.
The customer spending and the customer growth.
Yes, sir.
Okay. So group 2, how many KPIs are you seeing? Do you agree with the group 1?
I think I'm looking at 5 KPIs. The first one being the average spending per customer, which is 12 cedis, which is the first information. The second information, which comes in 3s, the customer figures, 1,000, 1,300, 1,690, making 4. And the third one being the annual growth from 2022.
So you are seeing 5.
I'm seeing 5.
Group 2, group 1, 2, group 2, 5. Okay. In actual fact, All the 5 are KPIs. All of them are KPIs. But we shall be dealing with 2. We shall be dealing with the 2 that group 1 stated. Okay, next question. Yes?
Okay.
Group 1, what was the answer to the next question? Use the relevant assumptions or the KPIs to create projected demand figures from 2025 to 2027. What are you getting?
So because
First of all, what should be your base figure?
our base figure is the previous year, the 1,690.
Very good.
Yes.
Very good. So you are projecting from that base figure.
Yes.
Very good.
So
Move.
that is where you multiply with the customer growth rate, which is constant, the 30%, to get the subsequent year, which is the 2026.
So how much did you get?
For the 2025, you got 2,197.
Okay. Then
And so the
2026.
subsequent year, 2026, you multiply what you got in 2025 with the constant annual growth rate.
Very
and
good.
it follows that suit. The following year, you multiply what you got in 2026.
do you agree with them group 2?
Yes, sir, we agree.
Did you get the same figures?
Yes, please.
So in your own business, can you do that? Can you use certain? So if you are using an Excel, you impute the formula
Yeah.
against that row.
Yeah.
Then by producing the first and the it will generate the rest,
Figures.
projected financial for the demand for you. Okay, now let's move to the third question. The third question says use the relevant assumptions to create projected revenue figures from 2025. So you are starting group 2. What figures did you get? Now, let's see. What exactly will you be doing? What are you multiplying?
So,
Because we are trying to get projected revenue. So what are we multiplying?
so for the projected revenue, we multiply the projected demand with the average spending per customer, which is the 12 cedis.
Do you agree? Because we are working with principles.
Yes, sir.
Do you agree?
Yes, sir.
Okay. So give 1 or 2. Year what? Year
And
25.
So, year 2025, we got 2,197 multiplying 12 cedis, and we got 26,364 Ghana cedis.
26,000.
Yes.
2026.
2025.
2025. 26,000.
26,000. Yes.
300 what?
364.
Did you get the same thing?
Yes, sir.
Have you gotten the same thing?
Yes, sir.
Okay. Now I'm okay with it. Let's move because you gotten the principle. That is the most important. Let's move to the next question. What's the next question? What are the historical revenue figures from 2022 to 2024?
Yes, please.
Daniel,
We have 1,003, 1,690
the historical
from 2022 to 2024.
Okay.
historical revenue figures.
Yes.
And it's what? This revenue figures.
Oh, okay.
Yeah.
Uh-huh.
Okay.
So what's
sir,
the principle?
since it
What
is-
are you doing?
So we are multiplying the customer spending, which
Uh-huh.
is the 12 cedis, by the previous data for the customers. So you have 12 cedis by 1,000.
Uh-huh.
So you have 12,000 in 2022.
Have you gotten it?
Yeah.
So you see, when you understand the principles, you can easily create your own data. So that's the principle. Because revenue is the quantity demanded or the quantity sold by the price per unit, and you are giving the price per unit. That is why with the market research, you pick the price per unit, the cost per unit, and all those, and they become your KPIs, and you use it to create the figures. Okay, now let's see the last. If a KPI in this assignment changes, what happens? Now we are using 2 KPIs. Let's take 1 KPI and see something.
I wanted to ask a question.
Okay.
Yeah. So if your business is at the idea stage, how are you going to predict the annual growth rate?
Okay, that is why we said use. That is why it's at the idea stage and you want to project into future. It's at the idea stage, and because you need some financing and you want investors to buy into your idea, you are projecting your revenues, your costs, in order to project your profits. That is why you need that market research. That's why you need those data. You gather those data from the external sources, competitors, industry reports, trade association reports, Ghana Statistical Service, and so on and so forth. That's why you pick all those data and just combine, use to create these things. Okay. So now, assuming one of those two assumptions change, assuming the per unit price changes, it reduces from 12 to 10. What happens to the revenue?
There will be a decrement.
What? A decrease in revenue, and a decrease in what else?
The demand and revenue will also decrease
if the demand is constant, but the price reduces. Assuming people are still demanding as usual, but the price reduces from 12 to 10. What happens to your projection, your projected figures?
The demand will also increase whilst the revenue has decreased.
We are holding the demand constant. We want to see the impact on the revenue. Is revenue is going to increase?
No. I think
revenue will rather decrease.
Yeah.
And then cost per production would.
No, cost is constant. Because you are producing at the same cost. So revenue reduces. And what else? The final. What will be the final impact? Revenue minus cost equals what? Profit.
Yes.
So if the cost is constant, the cost of producing it is the same. But the price unfortunately reduces from 12 to 10. What happens to the profit?
It will also reduce.
It will also reduce. That is why we said that anytime the KPI changes, if it's favorable, if it increases to 15, then the revenue is going to increase. All things being equal, assuming the demand remains constant and the cost remains constant. If price increases, then the revenue is going to increase and profit is going to increase. If it's the reverse, then you are affected negatively. The same thing happens to the cost. This was exactly what you started doing. So, the cost, assuming the cost per unit cost of producing the good was 3 cedis. Per unit cost of goods produced, what will it affect? Which row? Use the ABCD there. Which row is going to affect per unit cost of producing the good? You see to the extreme left, ABCD.
Yeah.
Which letter per unit cost is going to affect what? Row C. Have you seen row C?
That's the cost per unit.
The cost of goods sold.
Yeah.
So if the cost is 3 cedis, can you project the total cost of goods sold? 3 cedis times the 1,000 is going to give what? 3,000.
3,000.
So the 3 cedis times the 1,003 is going. So you use the 3 cedis as the cost assumption or the cost KPI to generate all that projection. Have you gotten it?
Yes.
Do you understand it?
Yes, sir.
Now the rest becomes mass. If you can create your own KPI, key KPI that will be driving your business, if you are able to create it, get the KPI or the assumption right, everything else becomes mathematics. So now the rest are becoming mathematics. Now you've gotten the revenue and the cost. So you subtract the revenue, the cost from the revenue, and you get gross profit. Cost of revenue minus cost of goods sold will give you row D, gross profit. Have you gotten it?
Yes, sir.
Okay. So if you are using Excel, then you impute the formulas there. Revenue line minus cost of goods sold line gives you the gross profit. Now, with the gross profit, you can calculate what we call gross profit margin. Gross profit margin is gross profit divided by revenue times 100. So the margin will give you the percentage of the revenue which is left after taking the cost of producing it. It gives you the percentage of that revenue. After that, now we have all the operating expenses, the overheads, all the operating expenses. Have you seen it? Okay. Then we are going to take away the operating expenses from the gross profit. So we are taking away from rows E from row what? D. Row F from row D. So gross profit minus all the expenses, other expenses, will give you another profit called operating profit or operating income. And we usually call it EBIT. EBIT is earning before interest, tax, depreciation, and amortization. So whatever you earn after deducting the overhead expenses from the gross profit, you get EBIT or the operating income. Do you get it? Any question here? That place you haven't deducted interest. If you have taken a loan and you are paying interest, you haven't deducted the interest yet, because that's the cost of financing. If you have a depreciation, if you have an asset that lasts beyond 1 year and you want to depreciate it, you haven't taken the depreciation. It's an expense. Interest is an expense. Depreciation is an expense. Taxes are expenses. But if you haven't taken these three from your income, from the profit which is left, that is what we call EBIT. You haven't taken it yet. So it's earning before taking interest, taxes, and depreciation. Okay. So now we are going to take away the interest, depreciation, and the tax. Assuming your company will be paying interest on loans taken, then we'll be paying some depreciation, or we'll be paying taxes. Then we take all of them from that EBIT income or the operating income, and that will give you the net profit or the net loss. Have you followed it? Have you followed it? But when you are using Excel, you can impute the formulas there, and it will be generating for you. If you get the thing right from the beginning, the rest becomes maths, and you calculate it. So the most important thing that the board and the investors will be looking at is your ability to go through this to show your net income or your net profit. One other important thing is, a lot of people always want to start projecting profit. It is usual for you to get losses for the first year, second year, but ultimately you must prove that you'll be able to turn things around and get profit at the net level, the final level, which is the net. You must be able to prove that the business will eventually be very profitable, because that will attract the money. If you are unable to prove that, it will be very, very difficult. On the same slide that you have this, you may be able to show, to draw a graph, bars or graph, to show the relationship between the net profit or the net loss against the revenue. And that is very, very important. In fact, it's very, very important to prove visually. A lot of investors don't have time. They will just look through the figures and, most importantly, check the graph to take whatever they need. So using a graph or a bar is very, very important. Over here, I provided 4 assumptions. 4 assumptions. Just to tell you that it's not good to go beyond the 3. The 4th one can be hidden. But it will be very, very important. It will be necessary, but it will be hidden. So that is it. So we've gone through this thing, and I believe you'll be able to use this guidance to create your own projections, financial projections for your business between 3 and 5 years. That will be able to convince the board and the investors that will be watching you and that will be following you to get your financing that you anticipate. Any question? Okay.
Yes, thank you very much. So I was looking at earnings before interest tax. So in case you want to input a particular tax or something and you don't have an idea, or it doesn't really matter.
Okay, that's it. Then you still do your market research too. You contact IRS to check how much to impute.
For the tax?
Yes, for the tax. See, all those things, see, that is why we are saying that whatever you put there, you must be able to defend it. That according to IRS, at my level, my required task is this. So that it's not just a mere guesswork, but it's a scientifically based guesswork. Okay. I believe we are okay, and you'll be able to create your own. Very good, and good luck to all of you.
So one more question, sir. You asked the question that if the pricing is reduced from 12 cedis to 10 cedis, that will actually reduce the profit also. But
the revenue and the profit.
Exactly.
But it will have a spillover. It will trigger changes in everything here. If we are using the Excel now, if we are with the computer and using the Excel, you just change one of the KPIs and you see that a lot of figures will change. It tells you that it's changing, and that row, change in that row alone is changing the gross profit, it's changing the EBIT, it's changing the net profit, it's changing a lot of things. If you change one cost, it will happen. It will change a revenue assumption or a cost assumption. It will change.
But is it necessary to also include here that in future it can boost that is sales? Or over here we don't put it here?
Okay, no. With your assumption, you use an assumption, just one, unless you want to say that, okay, the price that I'm starting with is this, but from the look of things, this price increases by this rate, and you impute that rate over there so that it will be increasing. You can use a price, and you said for the first year, the quantum of the price is this, but it has an annual growth of this, and it becomes a KPI. So every year you will be 10% increment, and it will be increasing 10% every year. So now the time is up, and I thank you all, and it's my wish that you are able to create a very convincing one for your own business and meet the board and succeed. God bless you. Bye-bye.
Thank you, sir.
All right. I believe you have been blessed and you have been edified like I have. It's been interesting looking at all of these things. I believe the contestants are going to really take cues from it and do a very good presentation, because remember, eviction continues. Who is going to continue in the competition and who is going to fall under the pressure and leave? Remember, the program is brought to you by Hope Channel Ghana in partnership with Seedspring Network. And we have Adventist Heritage Cooperative Fund and the National Entrepreneurial and Innovative Program supporting, together with our donors. Keep watching the pitch, because your dream could also become a reality.